you could see spending pick up pretty substantially in the second half of the year. And that would be a good thing, of course, but it could also put upward pressure on prices. And I would just say that essentially it doesn't seem likely that would result in very large increases or that they would be persistent. We've all been living in a world for a quarter of a century and more where all of the pressures were disinflationary, pushing downward on inflation. We've averaged less than 2% inflation for more than the last 25 years. Inflation dynamics do change over time, but they don't change on a dime. And so we don't really see how a burst of fiscal support or spending that doesn't last for many years would actually change those inflation dynamics. I will also say there's forecasters need to be humble and have a great deal to be humble about, frankly, but
Slow it down a little, Colonel. You're a little fast. Colonel, slow it down.
Something's happened to my foot.
Colonel, slow it down, please.
Hold on, Charlie. I think we got another gear here.
Colonel Slade!
Watch out!
It's killed!
Don't blame me, Charlie. I can't see.
All right, today is Wednesday, April 8th, and this is a recap for the market activities today. We have been talking about the three dynamics dictating the market's direction these days: the virus, inflation, and treasury yields. They're linked in a chain. You cannot unlock inflation without defeating the virus first. And defeating the virus is, in a nutshell, a normalization and reopening of the economy. The market processes the data every single day and asks the question, do we have enough information and enough facts supporting that we are heading toward a reopening and normalization? And if that is the case, then the door for higher inflation will be unlocked. And if we continue to see inflation expectations rising higher, that will unlock the door for treasury yields to rise higher. And in this environment of higher yields and higher inflation, the market's landscape changes and it becomes less favorable and more difficult to navigate. It becomes a stock picker's market and it does not produce the same insane returns under the deflationary regime of lower treasury yields. And the problem from all of this is the following. The party will be over. It's a game of musical chairs. We know how this movie will end because if we have higher inflation leading to higher treasury yields, that will eventually lead the Federal Reserve to tighten monetary policy via increasing interest rates and tapering the assets purchasing program. Now, remember, the market doesn't care about economic news. The market has been divorced from the economy and from corporate earnings for years and years and years. The market cares not if there is a civil war, pandemics, nuclear wars, asteroids, extinction of humanity, stocks will continue to go higher so long as the cocaine operation continues to flow. What is the cocaine operation? Fiscal and monetary liquidity. Well, now if we are heading toward the future of monetary tightening with interest rates being jacked up higher once again, and we see tapering of quantitative easing, then the stock market will collapse. It will crash regardless of how good and how hot the economy is. And therefore, we've been saying all along, good economic news is the number one enemy for the stock market because good economic news will lead to monetary tightening. Now, the Federal Reserve has been playing games. Last year, when the economic outlook was doom and gloom, the Federal Reserve administered propaganda, unleashing any whiff of good news and advocating to push inflation expectations higher. Now that we have the vaccines, we are seeing good economic news after good economic news. We are seeing the light at the end of the tunnel, and inflation expectations exploded higher. The Federal Reserve wants to twist and turn and play the game in the opposite direction. They want their cake and they want to eat it too. They want good economic news, they want a hot stock market, and they also want inflation. But every time the stock market throws a fit based on inflationary fears, now the Federal Reserve, that was last year pushing for higher inflation expectations, now they want to tamper inflation expectations. Earlier this year, when Treasury yields started to rise higher impulsively due to the rise of inflation expectations, the Federal Reserve followed the first page in the propaganda playbook, which is deny, deny, deny. There is no inflation. The risk of inflation is imaginary, yada, yada, yada. The bond market called the bluff, and yields continued to explode higher and higher and higher. So the Federal Reserve decided to use another trick in the propaganda playbook, which is acknowledge inflation, but now say that inflation is transitory. And even if it is not transitory, we got the tools, bro. And by tools, they mean cutting the cocaine operation and hiking up interest rates, which is a recipe for disaster, not just for the stock market, but perhaps for the entire economy. But they keep saying, even if that's the case, we are going to end the party. We will let you know in advance, well in advance. Because for now, we're not thinking about raising interest rates. But if we must raise interest rates abruptly, we will let you know in advance to exit the dance floor and go home. Does this sound too good to be true? To have a hot economy, higher inflation, higher stock market, jobs all over the place, and even if the worst outcome becomes a reality, we will get an advance notice. Ask yourself a question. Are you this stupid? Does this sound too good to be true or what? And you are starting to see more skepticism about this specific propaganda playbook, poking holes in this whole transitory inflation. And furthermore, more critics are waking up to the fact that it is a game of musical chairs. Extending the music all you want, at the end of the day, the Fed will tighten monetary policy if inflation rises beyond expectations. And why would inflation rise beyond expectations? Why would we have a hyperinflation risk? The answer is the money supply, that tsunami of liquidity that the Federal Reserve and other central banks around the world unleashed on global economies to respond to the coronavirus crisis. If you know anything about inflation, you know that a rise in money supply is usually, historically speaking, accompanied with higher inflation. But there is another missing recipe to spark the fire. You have the stash of money supply, but where is the spark? The spark is the velocity of money. And if we are heading toward reopening, and you have all of this pent-up demand from all the stimmies and the personal savings rate, which is through the roof, then the velocity of money will pick up and increase rapidly, leading to perhaps one of the biggest inflationary period we have ever experienced. And a lot of critics are pointing out that inflation will not be transitory, given the level of money supply and the velocity of money that's about to come. So what is the other page, the next page in the propaganda playbook by the Federal Reserve? Because page number 1 of denying inflation failed, page number 2 of saying it is transitory, and even if it is not transitory, we got the tools that exposed the end outcome of this whole fiasco, which is tightening monetary policy. And the market is not going to like that. So now they have to use another page from the propaganda playbook. And that page is censoring the data of money supply and the velocity of money. They're now not updating this data. No freedom of information whatsoever. Why are they doing that? They're trying to tamper inflation expectations by violating one of the essential cores of freedom in this country, the freedom of information. But once again, this is a dirty tactic, and it will fire back. So today we saw page number 4 of the propaganda playbook by the Federal Reserve. Chairman Jerome Powell was doing a conference with the IMF, and he decided to look at this slide and say, how about we lock the door of inflation to begin with from the root of the first dynamic impacting the market, which is the virus. All of a sudden, Jerome Powell is channeling his inner doctor, his inner scientist, and he's saying, oh, pay no attention to all of the inflationary data we've been receiving, specifically the March jobs report, which was a very hot report. And he is now saying, well, the true picture of unemployment is actually much worse than we expect, and the risk of the variants of the virus and the resurgence of the virus is real, and perhaps we're not out of the woods from the first factor, which is the virus. Perhaps we're going to see more lockdowns. And once again, these maniacs would love to see a resurgence of the virus and more lockdowns because it will give them more time to think about how would they fix this disastrous experiment that they have done. It will tamper inflation expectations and it will push equities higher. Therefore, good news, economic news that is bad for the stock market. And bad economic news is actually good for the stock market.
Viruses are no respecters of borders, and until the world really is vaccinated, we're all going to be at risk of new mutations, and we won't be able to really resume activity with confidence all around the world. So it's not only the right thing to do, it's also the smart thing to do, as the Director General just said.
When you think,
I would look at global vaccination as a risk, really, to something to weigh in as a risk to the progress that we are making. So it's something that we track very carefully, of course, and call out as a risk. And by the way, there's a risk here in the United States as well. Cases are moving back up here. And so I would just urge that that people do get vaccinated and continue socially distancing. We don't want to get another outbreak.
Chairman Powell managed to impress the market today, pushing yields down and equity prices higher, because today he threw cold water on the recovery from the virus and therefore locking the door for inflation expectations to rise higher and for treasury yields to also rise higher. And the question is, how long will this page from the propaganda book of the Federal Reserve last? Because it is a matter of time before we see more vaccine progress in the European Union and other territories, leading to more economic normalization around the world. But the question is the cabal of central banking actually wants this outcome, or are they in favor of more lockdowns, and perhaps they are praying for a new variant of the virus to cause more lockdowns to come, because that will give them more time by tampering inflation expectations. And why is this important? Remember the end of the movie when the Federal Reserve hikes interest rates and ends the party once and for all? They want to delay that outcome as much as possible because we have zombie economies and zombie companies, highly levered. If interest rates rise abruptly, you will see economic destruction like you have never seen before. So they want to buy more time, allowing these balance sheets to improve for all of these zombie companies and zombie economies before they are able to absorb hiking interest rates and ending the party in the stock market. We will talk about this and a lot more during the various segments of this video. But for now, let's start by covering the market performance today. And here we go. The Dow Industrial Average closing in the green by 57.31 points, or a gain of 0.17%. The Nasdaq closing in the green and leading the day with 140.51 points, or a gain of 1.03%. The S&P 500 closing in the green by 17.22 points, or a gain of 0.42%. And what about the sector's performance for the day? Leading the pack at number 1 and capturing the gold medal, technology. At number 2 for the silver, consumer cyclicals. And at number 3 for the bronze, basic materials. Meanwhile, the laggard of the day is energy, closing severely in the red. There is this consensus among money managers that energy stocks and energy prices will decline all the way till the summer, and they should dump energy and buy big cap technology instead. But they are expecting that oil prices and energy stocks will resume the rally in the summer, and this seems to be a consensus, at least from my sources. Moving on to cover the futures market performance, and let's see what happened here. Starting with crude oil. While energy stocks had a terrible day, crude oil prices actually closed in the green, and the reason is the US dollar continues to pull back. Modest gains for both the WTI and crude oil Brent. But the pullback in the US dollar was very good for the rest of futures. Specifically in softs, we have gains for lumber, massive gains. We are now trading well above 1,000. We also saw sizable gains here for cotton futures, and I do expect cotton futures to start outperforming once again. And the reason is there are a lot of boycotts from cotton coming out of China, specifically from the Xinjiang region, and that will eventually lead to supply shortages. So I did open contracts for cotton. We also saw gains for sugar futures, OJ, coffee, all closing in the green. The only laggard in softs futures, coca. What about metals? Metals like it when the US dollar declines. Gains across the board, led by silver, copper, gold, platinum, and palladium. What about meats? The new tech, lean hogs. Another day, more gains for about half a percentage point. But we did see pullbacks, modest ones, for both feeder cattle and live cattle futures. What about grains? Massive gains for grains, led by corn futures, closing over 3% today. But we also saw sizable gains for wheat, canola, oats, soybean oil, soybeans futures. The only laggards today were soybean meal and rough rice futures. But you take a look at the screen, treasury yields are down, the market is having an orgasm, rallying higher. Inflation expectations are quote-unquote tampered, at least according to the Federal Reserve and their propagandists over at CNBC, Bloomberg, the Wall Street Journal, etc. But you take a look at futures prices, lumber surging higher, copper surging higher, grain surging higher. But where is inflation? Is it right here? Where is inflation? Perhaps it's right here. Oh, I'm sorry. Moving on to the big casino, the options market, and let's see what took place in the casino today. The action led by Apple. We saw the volume for Apple doubling, and Apple has been on a tear throughout the week. Apple leading the pack with about 2.3 million contracts. About 70% of those were calls. When fund managers buy the Qs and technology ETFs, they have to buy Apple. And a lot of traders anticipated that ahead of time, and they started buying calls. And these calls appreciated handsomely. At number 2, Tesla, with about 600,000 contracts, about 62% of those were calls. And at number 3, NIO, with a little over 370,000 contracts, about 65.5% of those were calls. And I am leaving the list a little longer today because throughout this week and last week, we've been seeing pumps and dumps all over the place. You see a surge of call options buying, creating a mini gamma squeeze in a certain name, pushing that name higher, and then the herd chases the move after the fact, buying calls or buying the stock, only to see the name being dumped the very next day. We saw that with VipShop and many Chinese names. And we saw it last night with SOS, another Chinese name. Massive call options buying yesterday, and the stock popped higher. Today, the stock is being dumped once again. It's a risky game. Either you have a strategy, a specific standing, and you stick to that standing, and you're going to weather all the volatility and the moves in the market. But if you keep chasing the action, hopping from one trade to the other, you will get slaughtered, because in this very low volume environment, lots of pumping and dumping is taking place. It doesn't take much to pump a stock higher under a low volume week. What about the unusual trades that took place in the options market today? Let's start with the ticker INDA. This is for the Indian ETF. We talked a few days ago about the Sensex, the Indian stock market. It is on absolute mania, a crazy bubble, but the weekly chart is starting to show a lot of weakness and signs for an upcoming reversal. A couple of days ago, the Sensex was down big, about 3% at the lows of the session, and I do smell a massive correction in the Sensex very imminent. And perhaps this trader agrees with me because they bought the 38 puts expiration date May 21st with expectations that the Indian ETF will decline over 9% by then. They paid about 30 cents a piece to enter this trade, which brought the total all the way to $400,000. What about the trade for the ticker PTON for Peloton? They're making a bearish bet here by buying the 100 puts expiration date May 21st with expectations that the name will decline over 19% by then. They paid big bucks for this one, $3 a piece, bringing the total all the way to $3.5 million. And what about the trade for the ticker APD? This is a chemical company that specializes in gases, the likes of nitrogen and helium. And it is a very unusual trade, so I did follow this one. They're making a bullish bet by buying the 310 calls expiration date June 18th, with expectations that the name will climb over 9% by then. They paid about $2.60 a piece to enter this trade, which brought the total all the way to about $2.5 million. What about the trade for the ticker UAL for United Airlines? I do have data for you regarding the TSA checkpoint during the headlines of the day segment. And they are making a bullish bet here for United Airlines by buying the 63 calls expiration date April 23rd with expectations that the name will rise over 6% by then. They paid about $1.10 a piece to enter this trade, which brought the total all the way to about $600,000. And what about the ticker OMI for Owen and Minor, a healthcare company? Another very unusual trade. They're buying the 42.5 calls expiration date May 21st with expectations that the name will climb over 13.5% by then. They paid about $2 a piece to enter this trade, which brought the total to about $1 million. And lastly, what about the trade for the ticker IBM for, you guessed it, IBM? I've been bullish on this name for a while now, because it has been an underperformer for a while. But we are heading in an environment in the market where names like IBM, classic value names, will appreciate significantly because they generate enormous amount of cash in the present time. Needless to say that IBM also acquired Red Hat. We haven't seen the fruits from that acquisition, but perhaps that will come in time. My thesis is based on the technicals. You have a downward trend for years and years and years that got broken. We are starting a new, fresh, bullish run in IBM. I already own calls for IBM. If the name expires in the money, I will exercise those options and own shares of IBM. But in this particular trade, the trader is making a bullish bet by buying the 145 calls expiration date April 23rd with expectations that IBM will rise about 7.5% or more by then. They paid about 85 cents a piece to enter this trade. All in all, bringing the total to about $400,000. Moving on to the headlines that shape the day, starting with macro news. One of the factors shaping the wall of worry that we discussed last night is the tension between the United States and China. But we said that the market is in its Taylor Swift mode right now, and it is shaking off every single worry and potential risk for the market. But the tensions between the United States and China are brewing in the background. And here it is, U.S. blacklists 7 Chinese supercomputing entities citing national security concerns. And rest assured, none of these names, to my knowledge at least, are traded in the stock market, so you're not going to be holding any bags here, but you got to be careful with Chinese names because the tensions are only going to get more intense as time goes. And then we received the initial jobless claims, the weekly jobless claims, on the heels of the stunning jobs report that we got for the month of March. We have some contradictions here because we are still registering over 700,000 jobless claims. Matter of fact, this time around, 774,000. Meanwhile, the estimate was 694,000. So we are beating the estimate in a negative way. But remember, the market feeds and loves bad news because bad news mean that inflation expectations will be tampered and therefore the cocaine operation will run for a little longer. And the bulk of the claims came from the states of, surprise, surprise, California and New York. Now, I do live in California, and remember, this state is a mess, but it is very generous with benefits. You don't need much to apply for benefits. Benefits all over the place. They're collecting the taxpayer money from hardworking people, and they're blowing the money all over the place. And therefore, lots of taxpayers are protesting by moving to Arizona, Texas, and other states. And then we received an update for the health of the airline industry, specifically the U.S. TSA checkpoint numbers. We're not back at pre-pandemic levels, but we are making significant progress, and people are flying more and more and more. And you might have heard anecdotal evidence from people you know in your own circle who flied recently. Oh, the planes are packed, the airports are packed, etc., etc. And that's just not anecdotal anymore. We have the facts, and we are making significant progress in resuming normal flying. This is in the camp of good news, which the market doesn't like, by the way. And if you do remember, last night we talked about another risk for the market in the wall of worry, and that is the risk of taxation. Now we have states having to raise taxes significantly, specifically on the rich. But when they say the rich, at the end of the day, the middle class will carry the majority of the burden of taxation because the rich enjoys many loopholes not available for regular folks. And here we have the whiny bitches of New York City, the wealthiest, and they are looking to exit the state in anticipation of massive tax hikes. And of course, these wealthy New Yorkers, they will not be able to survive anywhere else. I know that as a fact, by the way, because when it comes to New Yorkers, specifically the rich, they're like fish. When you get them out of the water, they cannot survive. They might move over to Florida, enjoy the sunshine for 2 minutes, but they're gonna miss New York. Oh, I miss my favorite restaurant. How am I gonna survive without Dorcia? Poor you. This is the plight and the suffering of the poor rich. Oh, the agony. How could you survive without your favorite restaurant? But perhaps the rich should not whine and bitch and complain anymore, because when it comes to inflation, they're hardly touched. Surprise, surprise, inflation hurts the middle class the most, because when it comes to the poor, they receive benefits and they can juice the system for more benefits, specifically in states like California and New York. But when it comes to the middle class have to eat the bag of you know what, pay more taxes, and suffer the negative implications of higher inflation by paying more for everyday goods. But where is inflation? I can't see inflation. Can you? Where is it? This imaginary inflation. And of course, inflation is leading Treasury yields to spike higher. And now we have the data. It's all fun and games until the government has to issue 372 billion of Treasury notes and bonds in a single month. The largest amount ever recorded, because the government is planning to do spending on steroids, and they have to finance this spending by issuing more notes and more bonds. Now, the deflationary camp and the skeptics will say, well, the Federal Reserve can buy all the bonds. They can print money out of thin air, and they can buy all of these bonds, and we don't have to worry about Treasury yields spiking higher. I'll give you 5 minutes to realize that you're not really that stupid, by the way. And here we have the 5-year break-even inflation rate at the highest level in a decade. Yet don't expect the official data from the government to show and reflect the true picture of inflation in the economy, because here it is. Inflation in the things we buy every day is much stronger than the official CPI, which is lowered by adding weight to things we only purchase occasionally. And of course, the cooks over at the Bureau of Labor Statistics adjust the recipe and the formula all the time to make sure that the CPI and core inflation never shows and reflect the true picture of inflation in the economy, and therefore giving the green light for the Federal Reserve to continue their cocaine operation. But where is inflation? I can't see inflation. Is it right here? Is it right there? I can't see it and I can't smell it. I can't hear it. Where is inflation? Here is inflation. The UN World Food Price Index reaching the highest level on records, and it is the highest gain year to date so far in history. But where is inflation? I can't see inflation, can you? And you and I know that they're only going to start to acknowledge inflation when inflation reaches your wages. God forbid your wages go higher. Now we got to control inflation. Inflation is getting out of hand. No more. And today we heard more propaganda from the Federal Reserve. And remember, they're right now at page number 4 of the propaganda playbook, which is make the outlook more doom and gloom than it really is. We know that the so-called recovery is a zombified economy on steroids, on artificial stimulation, but they're never going to acknowledge that. But now that inflation expectations are getting out of whack and adding more pressure on the Federal Reserve to tighten monetary policy, and their whole bluff about not thinking about, all of a sudden when inflation starts to spike higher, inflation expectations that is, they will start shitting their pants. So page number 4 in the Federal Reserve propaganda playbook says, do a 180 and give everybody the illusion that the economic recovery is actually worse than expected and we still have a high number of unemployment and the virus is also getting worse and worse. Oh. And they unleashed one of their dogs, specifically Neil Kashkari. And we talked about Neil in this program many times before. And Neil, unlike other Fed personalities, is sort of a man of the people, meaning other Fed personalities don't mingle with the masses, they don't even acknowledge their existence, they sit on their $20,000 leather chair while issuing statements about the plight of the poor and the struggles of the middle class, etc., etc. Not Neil Kashkari though. Neil, while being a multi-millionaire, he's still man of the people. He pretends to be homeless and poor, and he is on Twitter communicating with the masses, and you can go back and forth with him debating issues. The problem is when you defeat Neil Kashkari in a debate, he will start crying and accuse you of bullying him, and he will block you on Twitter, just like he did with me. And Neil Kashkari today said that the real unemployment rate is pretty much around 9% or so, so it is a lot higher than expected. Again, page number 4 from the propaganda playbook. Make the outlook look more doom and gloom. And then he went on and said that he wouldn't be necessarily concerned if inflation reaches 4%. 4%. These mad scientists, according to the CPLI, their favorite formula, inflation at 1.5% right now. And look at the prices of lumber, copper, grains, food, gas, shipping costs through the roof, destroying the livelihood of American households. Can you imagine how bad inflation will get if this mad scientist gets his wish and inflation reaches 4%? But I know inflation is transitory. 1 minute it's here and then it disappears. And now you can't see inflation like John Cena. Where is inflation? It was here and then it went away because inflation got scared by our quote-unquote tools. Do you believe this garbage? And here is more from Jerome Powell. Powell says he does have the tools to deal with inflation if it is indeed rises higher, above expectation, and persists. And then he goes on and says that the traditional tool to deal with inflation is to raise rates. Once again, the cure is worse than the illness. Listen, I know with the cocktail of drugs that we're doing, the average American is doing, we have 3 brain cells left. But 3 brain cells are good enough for you to see what's going on here, to see how this movie will end. We do have the script. We know how the movie will end. Inflation will get out of hand, and the Federal Reserve will have to cut interest rates and end the party on Wall Street. The problem is, if that happens abruptly, meaning this year or early next year, we will see a crash like we have never seen before, the Great Depression 2.0, because raising interest rates in an environment where you have zombified companies and zombie economies all over the place, you will see the Archegos Capital scenario replicating 1,000 times all over the place. You're going to see explosions from funds, companies, even countries. So these mad scientists are playing with fire. And I know some of you have criticized me in the past by saying, oh, you're so good at transcribing the problem. But where is the solution? Why don't you give the solution? What am I, the president? What am I, the Fed chairman? And to be frank with you, there is no solution here. The solution is to cross your finger if you are Jerome Powell and hope that by kicking the can down the road and buying more time, that the balance sheets of these zombie companies and highly levered financial entities will get a lot better by time, so they will be able to absorb a hike in interest rates. There is no solution, baby. The movie is already playing. You can't turn it off. The music will stop. The party will end. You just have to pray and hope that we will avoid the disaster scenario. It's a freak show, and the only thing you can do is grab a big bag of popcorn. The problem is that this bag of popcorn with this kind of inflation might cost you an arm. and a leg. And lastly, in macro news, let's talk about the Biden administration, aka the BlackRock administration. You know, they're talking about this infrastructure bill as it's a magic wand that will create an enormous amount of jobs. And don't worry about the debt and about inflation. We got it under control. And here we have the Associated Press doing a fact check on the claims of the Biden administration. What are they trying to commit suicide over the Associated Press? President Biden and his team have been putting on the hard sell as they seek support for his big infrastructure plan. An AP fact-check report find inaccuracies in some of their claims. Here is the claim. Biden, when asked if his proposed corporate income tax increase would drive U.S. companies overseas, he said, "Not at all, because there is no evidence to that. That's bizarre." Okay, but here are the facts. Hardly bizarre. Biden's administration is aware that lower tax rates abroad could tempt U.S. companies to move. Whether the proposed tax increase would be big enough to have that effect is another matter. The same day Biden made his comments, Treasury Secretary Janet Yellen endorsed a global minimum corporate tax rate precisely to prevent countries from cutting rates to incite businesses to move. In other words, the fact check is already done, and we call bullshit. Biden is proposing an increase in U.S. corporate tax rate to 28% from 21% to partially pay for his infrastructure proposal. President Donald Trump cut the rate from 35% in his 2017 tax law. Here's another claim regarding infrastructure jobs. Biden on his $2.3 trillion infrastructure plan. Independent analysis shows that if we pass this plan, the economy will create 19 million jobs. Good jobs, blue-collar jobs, jobs that pay well. And Brian Deese, or whatever the hell that is, the director of the White House National Economic Council. And he said, you look at just the analysis we've seen this week. Moody's suggests it would create 19 million jobs. Lying to their teeth, because here are the facts. That is not what Moody's Analytics said. The infrastructure plan is not expected to create anything close to 19 million jobs in less than a decade. Instead, the economic consulting firm calculated that nearly 16 million jobs will be created in the United States by 2030 without either Biden's infrastructure plan or the $1.9 trillion rescue package that was proposed and approved last month. At 1.6 million a year, that would be a sluggish pace of job creation, below the roughly 2.2 million pace before the pandemic. Once again, hello, stagflation. You know you can't say stagflation anymore because they'll ban you from YouTube. Moody's says the rescue plan will generate about 700,000 jobs over the next decade that otherwise wouldn't have existed. And it says that the infrastructure plan would create roughly 2.6 million over the next decade. That would total about 19 million, but with only a modest portion coming as a result of the infrastructure proposal. Here are more false claims. Regarding auto jobs, the Transportation Secretary, Pete Buttigieg, we are going to have auto workers, union auto workers, I hope, making cars one way or the other. Why not have them leading the revolution into electric vehicles, which, by the way, there is a very hot competition for with China and a lot of other places. Remarks Sunday on ABC's This Week. Here are the facts. It doesn't take as many people to build an electric car as it does a gas-powered one. And the jobs that would be created in these new factories may pay less. Electric vehicles generally have 30 to 40% fewer parts than traditional cars and are easier to build. As well, many jobs building the batteries used in electric cars are non-union jobs at companies that supply the automakers, rather than at unionized plants run by the U.S. car companies themselves. More lies, more deception. Where will the money go, by the way? We're talking about $2 trillion, perhaps more than $2 trillion. It's going to go into the pockets of contractors, bureaucrats, Wall Street insiders, lobbyists. Perhaps a tiny portion will actually go into infrastructure spending. It's the ultimate looting season, ladies and gentlemen. The treasury is wide open and the looters are all over the place. Moving on to market sentiment news. You know, all I hear from the Robin Hoodites, the zombies, and the perma bulls, they're not really perma bulls, they're perma pigs, But all I hear from them is, oh, look at the doom and gloom all over the place. Everybody's talking about a crash. Be greedy when others are fearful, bro. Well, here it is. The U.S. investor sentiment, bulls versus bears. We have the highest reading since 2018, meaning that the majority of market participants are bullish on the market, not bearish. You donkeys. Here it is. Bulls 56.9, the highest reading since January 2018. What happened back in January 2018? I'm not going to tell you. Open your charting platform, do some homework, and stop being lazy. What about bears? Bears at 20.4%, the lowest since April 2019. We have neutral at 22.7. So all in all, we're bullish. Grab your blindfolds. And what about the whole Archegos Capital / Bill Wang fiasco? We're getting more details by the day. And this man lost $20 billion in 2 days. $20 billion. You know, someday when somebody produces a documentary about this bubble, how it started and how it ended, this story will be one of the stories that will be highlighted as a warning for the market that everybody ignored. And just if you are curious and you actually want to lose $20 billion in 2 days, I got the details for you. Grab a pen and a paper or an iPad. Here it is. Number 1, start with a lot of money. No. I don't want to hear it. How do I start with a lot of money? I don't have a lot of money. Well, that's your problem, baby, because there is money all over the place, floating all over the place with a tsunami of liquidity. Just extend your hand and grab at the air and you will find cash. Continuing. Number 2, borrow a lot of money. Number 3, use all of that money to buy a ton of a small handful of stocks, cornering the market in those stocks and pushing up their prices, aka create short squeezes, gamma squeezes. Number 4, as their prices go up, you have more equity. Your positions automatically deleverage. Number 5, you use that equity to borrow even more money and plow it back into those stocks, pushing them up even more. Number 6, repeat forever until you go to the moon or the rocket crashes and you lose $20 billion in 2 days. More in market sentiment news. What about Peter Thiel? You know, I like this guy. He's a smart man, Peter Thiel. Or I'm just saying that because I want him to fund my new business idea. Anyways, Peter Thiel issued some negative statements regarding cryptos and Bitcoin, and all of you crypto maniacs might not like Peter Thiel anymore. I mean, after all, he dumped on your little heads on Palantir, selling over $500 million. But here is what's bugging Peter Thiel regarding crypto and Bitcoin. Thiel urged the U.S. government to consider tighter regulations on cryptocurrencies on Tuesday. These statements seem to represent a change of heart for Thiel, who is a major investor in virtual currency ventures as well as in cryptocurrencies themselves. And that will happen. Gary Gensler is coming and he's about to crash the party. Now, Gary's not anti-cryptocurrencies. He understands them and he will regulate them, and regulating cryptocurrencies and Bitcoin specifically will drop their prices and end the mania of volatility. The problem is that Gary Gensler will get his orders from the Federal Reserve and the federal government. And if the government wants a digital US dollar, then they will end cryptocurrencies and Bitcoin indeed. But keep listening to the donkey leaders with the deer in the headlights look in their portfolio pictures, because they obviously know better. And here's more bad news regarding the 21st century's tulip mania. China's Bitcoin mining is threatening its climate change targets, study says, and China doesn't give a rat's ass about the environment, wildlife, human rights. That doesn't matter to them. So they're going to pollute the planet all they want. And all of this EV mania, that all EVs are better for the planet, wait till the Chinese start accelerating producing batteries and EVs. They will exploit all of the resources, extract the nickel that they need, then dumping the waste in the ocean. Meanwhile, European and American companies will be beholden to uphold clean, environmentally friendly practices when it comes to producing their own batteries and EV components. So once again, China doesn't have any rules. They don't care about the environment unless it's the Chinese environment, and they will be able to undercut the likes of Tesla and other American and European manufacturers. But all I hear from the culties, the Tesla culties, the Elon culties, that Tesla is a monopoly and they have the advantage, and the robo-taxis, bro. Speaking of, moving on to corporate-specific news, starting with, you guessed it, the souffle. Here's an analyst from Roth Capital who triggered the culties. Perhaps this guy doesn't care about receiving death threats. That's how nasty the culties are. And he said that Tesla stock is worth $150, which means the stock will drop 78% from current prices. They would really need to deliver on the robo-taxis, the fully autonomous vehicles, the analyst said, adding that Tesla appeared to pull back its efforts in that area, while other companies are coming out with quote-unquote vastly superior technology. The souffle is melting as we speak, but the culties will only notice after the fact. Oh, but Elon says. And by the way, the souffle doesn't even deploy their own vehicles in their maintenance fleet. They're actually using Ford vehicles. But I know Ford is the dinosaur, the ice that's about to disappear, and Tesla's the monopoly, and it's way ahead of the game, and it's gonna defeat and destroy and disrupt everybody. At least that's what Mama Kathy said to me. We'll see. Moving on to AB InBev, aka Budweiser. And they are testing driverless truck technology. So should we double the stock on drunk driverless trucks optimism? Moving on to cruises, not just a specific company, but the entire industry. Florida sues the CDC to allow cruises to resume U.S. sailing. Industry pushes for better treatment, and they're gonna bitch and whine to the CDC about letting cruises sail again. The problem is the CDC is not taking any risk, and mind you, the Federal Reserve and the cabal of central banking, they want to scare us that there are new variants that could create more lockdowns, and we're not out of the woods yet. Papa Jerome himself is saying that cases are rising here, so forget about the CDC allowing cruises to sail again. Moving on to McDonald's, Mickey D's. And the CEO made more than $10.8 million last year. I didn't know they hired the high schoolers to be CEOs too. McDonald's would have saved a lot of money if they just paid this guy in Happy Meals. What about Netflix? Netflix will get exclusive streaming rights to future Sony films. And I'm not sure what that means to the Sony streaming service, the Bravia. Is that cancelled or what? But I do believe that it's better for Sony to abandon their streaming hopes and just license the content and sell it to the highest bidder. That way, they're not involved in the streaming wars. They could give a rat's ass if the movie's a hit or not, and they essentially become a bullet stock, because it doesn't matter if Netflix margins are being squeezed or not. They have to buy Sony content anyways. Moving on to the WWE. The WWE is fully converted to Peacock now, the Comcast streaming service. Now it wants to make more content. The problem is, if you are nostalgic to old school wrestling from the 80s and 90s, you're not going to find this content anymore because they're erasing the content due to racism. They're accusing the fake content of being racist, and it's being erased. But regardless, I am bullish on the stock because it is, once again, a bullet stock. And if you look at the chart of the WWE, we do have a cup and handle formation that is supposed to play to the upside. So I already own calls for the WWE. What about Visa? The U.S. antitrust investigation of Visa is probing incentives that the card company offers banks that route more debit card spending through its network. Isn't that what they're supposed to do? What about the drug companies paying doctors to push drugs on us? That's another one. What about Verizon? Verizon recalls 2.5 million hotspots devices due to fire hazard. You can recall them, or you can change the name from hotspots to cold spots. You see how smart we are? Moving on to the heat map analysis. Today we saw yields taking a massive leg lower, and that in turn helped the technology and the mania names to rally higher. Yet we are not seeing a rotation out of one sector of the market in favor of another. we're seeing big cap technology names outperforming significantly this week. Meanwhile, the mania names, up one day, down another, being dictated by the action from the options market. The inflationary trade, on the other hand, we saw some profit taking in energy, but when it comes to industrials, materials, defensives, and even financials to a certain extent, we're not seeing money being pulled out of there. If anything, they are gaining inflows. At the end of the day, we talked about the dilemma of the two different routes the market is debating taking. And what dictates which route the market will take at the end is the final trajectory of Treasury yields. Is this a pause and we will resume the rally in yields later on? And if that is the case, then the dips in the inflationary trades are to buy, and the rips in the deflationary trades are to short. So at the end of the day, the number one chart to watch here is the 10-year Treasury yield. Any other noticeable moves that we saw today in the market? We have big declines in AT&T and Verizon. We talked about Verizon a few minutes ago, and AT&T down over 3% today. And I pointed out to you in the options market coverage last night that it has been a consistent pattern. When we see massive call options buying in AT&T, the stock actually drops the next day. And this is exactly what happened with AT&T. What about the notable gainers beside the mania names and technology names? We do have beer. Beer did pretty good today, specifically Bud, on the driverless trucks optimism that we just covered. Now, let's take a look at the themes of the market, starting with the reopening names. What's going on here? Mixed picture, but mostly muted. We saw big gains for Planet Fitness and Diageo. All in all, there is no significant outflow out of these names. If anything, it is net inflow. What about the inflationary trade? Let's see what's going on here. Mixed picture, but again, we are not seeing a rotation out of these names in favor of big cap technology names. Once again, all in all, when we do the weekly coverage, you will see that the majority of these names actually gained throughout the week. So if anything, once again, they are experiencing net inflow, with exception of oil and energy names. Now, what about the deflationary trade, specifically the mania part of the deflationary names? Massive gains today, and these names are the most sensitive to the movement in Treasury yields. Today we saw a big decline in Treasury yields and therefore massive gains for these names. Whether we're talking about Snapchat, Okta, Peloton, Shopify, all with massive gains today. The problem is, if yields start to spike again, these are the same names that will suffer once again. So without consensus of where yields will trade the next few months, you cannot make any significant investment decisions with these names until and unless the trajectory of the 10-year Treasury yield is clear and it's to the downside. Moving on to the charts analysis, starting with the SPY 30 minutes chart. Anything new today? Yes, there is. We're building on the momentum higher, gapping higher overnight, or we are now trading in the sky is the limit sort of trading, the likes we saw back in November post the election, a series of gapping higher overnight on very low volume. But there is a difference between the gapping series this time around and back in November. We will discuss that during the Q's chart analysis. But for now, any valuable information from this particular chart, the 30 minutes chart of the SPY, all we know that the momentum is to the upside. You have to look for a sign of reversal before betting against the SPY. What are the two signs? Number one, gapping lower overnight significantly, or the one I prefer because usually that forms a solid top. The gap and crap scenario, meaning you wake up in the morning, you see a huge gap higher, only to be sold off throughout the day, losing all of these gains by the closing bell. On higher volume. That's very important. Higher volume. Absent of that, the sky is the limit for the SPY right now. What about the daily chart for the continuous contract? Similar story here. The bull flag is playing out to the upside. The negative divergence on the RSI is fixed, and the sky is the limit absent of a reversal signal. What about the Qs? 30 minutes chart. Gapping higher once again. We are in the series of bull flags. The problem is that we are leaving lots of gaps here to be filled. Zooming out to the daily chart of the Qs, just to show you the symmetry between the recent move of gapping higher and the move back in November. Similar story here, overnight gaps. This time around we have more gaps. Look at all of these green candles, at least 10 days in a row of gains in the Nasdaq. The problem is, usually when you see a series of gaps higher overnight, that is usually corrected right away with a massive flush down in about a day or two, closing a lot of these gaps. The difference is that back in November, when we saw that flush down, that was picked up right away with retail traders, meaning that back in November, the gapping happened on very low volume indeed, due to the balancing from portfolio managers. They've been waiting till after the outcome of the elections, and right away, even before knowing the winner, that evening, if you remember, the Nasdaq futures spiked significantly higher. They did not care who won, who lost. What mattered is that the elections are behind us. Now, once we saw that flush down candle back in November, the retail trader picked the action up. The retail trader was still there and managed to build on the rally. The difference this time around is that the retail trader is absent for now. Keyword for now. Let's say that we see a flush down in the Nasdaq tomorrow or next week, closing some of these gaps. Will the retail trader participate and buy the dip? That is the $1 million question, because passive funds and portfolio managers are not going to be doing rebalancing forever. It's this week and last week. What about the continuous contract of the Nasdaq? What's going on here? We talked about the resistance of 13,599. Now we have broken above that level. We spent 2 days with the resistance, and now we broke above it, turning it into support. We actually haven't tested it yet for support, and that is the next step. You got to go down and test 13,599 for support. That doesn't mean it has to happen tomorrow, because we have the all-time highs, and this is the very important level of 13,900. This is the destination that the Nasdaq futures are eyeing. For now, it is acting like a magnet, yet breaking above that level will prove to be extremely difficult, meaning that you have to go and revisit a support line, in this case, 13,599. Gather the energy and then blast higher above 13,900. Of course, all of that possible until we see a reversal signal. Once again, the reversal signal will happen with a gap lower overnight or a gap and crap during the trading hours. The gap and crap is much more powerful as a reversal signal than a gap lower during the overnight session. What about small caps, the IWM? What's going on here? The IWM remains the most important chart in this market. It is showing a bear flag consolidation right now. We do have a gap at around the level of 218, which happens to be a very important support line. The assumption here is that the IWM has to go down to 218, retested for support before bouncing higher. But the chart to watch here is not the IWM, it's the RUT, the Russell 2000 from a daily perspective. We have a bull flag consolidation, and if this turn lower is indeed a lower high, then we are starting to break the bullish trend, and perhaps we're already seeing a head and shoulder formation, and the bear flag or the head and shoulder formation, whatever floats your boat, will play to the downside, breaking the bullish trend that started in the Russell 2000 back all the way since September of last year. And the line in the sand is 2,264. Closing the week above that number will keep the bullish trend alive. Closing below it, meaning tomorrow, will be an ominous signal that the bull run in the Russell is over. Moving on to the Dixie, what's going on? The dollar index going all the way back to the level of 92. That should act as support, but even if it fails and the Dixie goes a little lower, that's okay, so long as the dollar index is not making a lower low, because making a lower low will end the bullish pattern for the dollar index. What about gold? The dollar is down, yields are down today. This is the ideal environment for gold to rally. And now gold is battling the resistance level of 1750. In my chart, it is 1760. It doesn't matter. It's a small difference. That zone is acting as resistance. And it is hand in hand with the 92 level in the US dollar. If the US dollar breaks 92 to the downside tomorrow, then the expectations are that gold will be able to break above 1750 and vice versa. What about Bitcoin? What's going on here? Today we have an upside day, and remember, we have the Coinbase IPO coming up very soon. That should excite the crowd and push Bitcoin higher, along with all of the proxies of Bitcoin, Riot Blockchain, Mara. But I got an interesting take today. What if traders are going to sell Riot Blockchain and Mara to buy the Coinbase IPO? That could be a possibility, and it is an interesting take, but the assumption for now is that they will rally together. If the IPO of Coinbase is successful, then that should act as tailwinds for Bitcoin, Riot Blockchain, Mara, and even other cryptocurrencies. Now, if the IPO bombs, that's a different story. We have to watch the negative divergence in Bitcoin. And I am highlighting something here in the chart. Are we seeing a lower high already? I have a question mark. And if that is the case, then the next step is to make a lower low. If we make a lower low, goodbye to the bull trend that started back in December of last year. What about yields? The 10-year Treasury yield. This is the most important chart to watch in the market. I do have the level of 1.622 basis points as the support. You can go below it a little bit, but if you start making lower lows, then the next destination will be 1.5%. Yields will decline all the way to 1.5%, and that will be good for big cap technology stocks, but specifically the mania names. What about the TLT bond prices? We talked about the ABC pattern that is still on the table. We haven't closed in the red Fibonacci zone for the week, so the TLT has the possibility still to go all the way to 139. And that would be the level to watch. If the TLT goes all the way to 139, and then we see the US 10-year Treasury yield making a lower low, that is your confirmation that the TLT is about to rally impulsively. We will go all the way down to 1.5% in Treasury yields. However, if yields catch support from the zone of 1.6% and blast higher once again, then you will see the TLT going lower. That's a no-brainer, but you also see the gains for big cap technology stocks and the mania names this week reversing lower. And the reason why I'm mentioning this, even though it seems like a no-brainer right now, you could see yields spiking higher, catching the support. Meanwhile, big cap technology stocks, the Nasdaq, and the mania names rallying higher. And then next week or a few days later, you see the Nasdaq, big cap technology, and the mania names reversing lower. So you could see that lag in reaction. So you gotta watch the 10-year Treasury yield chart. It is the most important chart to watch. Moving on to the VIX, what's going on here? The VIX is declining once again. And the big question is, are we not buying protection due to the low volume activities the last couple of weeks, meaning there is an element of complacency, or are we not buying protection because we're expecting a massive rally in the stock market, specifically in the SPY, the S&P 500? All I know is from a technical perspective, and I'm highlighting the MACD indicator. When you are about to make a crossing, creating green impressions in the histogram, but suddenly you decide to make a U-turn and dive lower once again, that is an ominous signal predicting massive losses to come. And we saw that happen right away. The VIX gap lower to close the gap from last year that was created from the pop of the COVID crash in February 2020. If you want my opinion, I am skeptical about the recent declines in the VIX, and I do believe that the VIX will pop higher once again. And the reason is, we have the potential of sell the news phenomena when it comes to the reopening names and the infrastructure stocks. We also have the possibility of yields popping higher once again, depending on the data we're about to receive. We have lots of macro data we're about to receive starting tomorrow when it comes to inflation. If the data shows more inflation and yields spike higher, that will come hand in hand with the VIX popping higher once again, because you will start to see a reversal in big cap technology names, the likes of Apple, Microsoft, etc. That will be enough to push the SPY lower and therefore the VIX higher. And here is the put to call ratio from a monthly perspective. This is the equities put to call ratio. We are at historical lows. And every time the put to call ratio reached these low readings, it was followed up by a reversal or a correction in the equities market. For now, the market is in the Taylor Swift mood. It is shaking everything off. And who needs protection? Who needs the VIX? Who needs puts? The majority of market participants are in the bullish camp, so there is this element of complacency in the market, even after we saw massive corrections, at least in the mania stocks. The likes of Plug Power, Tesla, Blink Charging, Peloton, etc. That is not phasing the market overall. Participants are not rushing to buy puts or protection by buying the VIX. What about Apple? What's going on here? Apple has been on a tear this week. Excellent week for Apple. Yes, gapping higher even today, but it is on this higher trajectory. Why? Because the center of gravity is now at 131, and that is the level that we have to close above from a weekly closing perspective to build on the rally. The problem is, and this is rationally speaking, we have retested the 125 and that was good enough to push the chart higher. But Apple is a technically sound chart. It doesn't like to leave lots of gaps open for too long. There are very few gaps in Apple's chart history that haven't been filled yet. So the expectations are that perhaps we'll go all the way to 131, but we're not going to be able to close above it. We will face resistance and then we have to go down, close some of these gaps, perhaps retest 125 once again, because this recent run is very steep and it will get exhausted. Part of the move higher is call options buying. We know that a lot of these options are expiring tomorrow, and the sentiment is very important here. Are they going to exercise these options and buy the stock? That will represent conviction that Apple has higher prices to go. But if they close these options, cash in the gains, and abandon the ship, then the recent leg higher was with no conviction. Option traders don't believe that Apple has higher prices to go. Perhaps it will consolidate here or even go lower. So watching how call options holders will behave tomorrow is extremely important. Lastly, what about the souffle, Tesla? What's going on here? Tesla still holding above 679. That is the line in the sand. You gotta close above 679. I'm not gonna be demanding and say close above 720, but at least close above 679 to keep the hope that this is a bull flag formation that will break to the upside. Now, when we look at the 30 minutes chart for Tesla, leaving the Fibonacci levels attached, you can see how accurate these levels are. The stock is trading almost to the penny to these levels, and for now we have 679 to watch. Closing below 679, then we are heading down all the way back to 625, 623, but closing above 679 will leave the door open to build on the rally next week and go all the way to 720. Moving on to conclude this video, what do we have on the economic calendar tomorrow? We have the producer price index, that is yet another important indicator for inflation. Then we have wholesale inventories, that is yet another important indicator regarding inflation, specifically for the supply side. Anyways, that's all I got for you tonight, and I will talk to you again tomorrow. Where is inflation?
I'm in the dark here.